Should we just have everybody in the front here take one step back so no one's getting crushed?
Yeah, thank you for the introduction. Thank you for being here. We're the last panel, the best at last, I think. Yeah. Diving into the topic, maybe a short introduction from every one of you, and to add, what would you add in the topic at fast that you could change the on-chain topic, which was a key topic the last 2 intense days. Maybe starting with David.
Yeah, good afternoon, everybody. I did contemplate bringing a case of beer with me in the hope that it might tempt a few more people into the front. But anyway, we'll move on. So, yeah, thank you. I'm David Reed. I'm from Invesco. My job title's changed subtly since this was set up. So we formalized our digital asset team at Invesco back in the summer last year. So, you know, I think there's recognition in our firm that this is a truly transformational set of technology and capability that, you know, and we believe that this is going to be absolutely instrumental to our growth moving forward. So, you know, our senior leaders have invested in that, and we've now got a fully fledged digital asset team, and we fully expect that to double in size this year. In terms of you know, our activity in there at the moment, we're split between providing crypto exposure through ETF products, both in EMEA and in the US, and then much more focused then on the subject I think we're talking about today, really, which is the whole ability for us to bring our investment capabilities and institutional funds, and how do we deliver those and bring those on chain. And you know, there's been a lot of activity, I think, over the last 2 years in that activity, driven by the driven certainly through the money market fund activity that we saw throughout 2025 and has continued into 26. And I think there's a lot of new interesting use cases coming forwards. But as I think we'll talk about during the discussion today, you know, some of the key issues that still present has been barriers to this has been some of the regulatory uncertainty and regulatory arbitrage that exists in this area at the moment, and distribution. I mean, that's fundamentally what we're about, is about getting our capabilities into the hands or into the possession of our clients, and we see that as being very bifurcated at the moment between there's frankly not an awful lot of demand for tokenized products. And I think I'm being generous in saying not a lot, in the traditional wealth channels and the traditional channels that we distribute our products through. However, there is an increasing and burgeoning demand coming from what you might call a new distribution channel, the Web3 channel, so blockchain protocols, treasuries, DAOs, and so forth. And that's certainly been an interesting area for us to explore and look at launching products there, which in turn will ultimately flow through to our more traditional channels as they become more kind of comfortable with this space. Anyway, let me pause there.
So yeah, I'm Matteo Pandolfi. Good afternoon, everybody. So I'm founder and CEO at Pareto Credit, and I would say my take would be very practical as we build on-chain infrastructure and on-chain credit infrastructure specifically. I would say at the moment, like for institutional adoption, especially for tokenization products, one of the main issues is that tokenization doesn't stop at the token level, but it's all the entire system that should be built around and should be really clear for institutional players to be able to adapt. So like clear rules, clear roles, settlement finality, all these kind of things should be ready for from day one, in order to be able to scale adoption throughout the institutionals. And so yeah, I would say echoing that most of the issues are around like regulatory clarity, being able to also integrate within the institutional system these kind of new products that has been issued. The efficiency is over there. We just need to make sure that the system that is built around the token can adapt also to the institutional players.
Patrick, I'm the founder and CEO of Members Capital Management. So we're an asset manager, and we specialize in investing in the reinsurance market. So we're based out in Bermuda, and if you know anything about reinsurance, that's sort of the heart of that market, or one of the hearts, in addition to a couple of others. And our investment policy is very traditional. We invest in primarily property catastrophe and cyber risk, so not crypto, but our distribution strategy is focused around leveraging, call it Web3 distribution. And I guess to add on to all the things that have already been said, and we'll cover this more, I mean, there's really a lot of thought that needs to go into product design as well, and primarily liquidity, transparency, and solvency are very big things. And I think one of the struggles from a very practical perspective of the institutional funds in the space is that when the underlying is not liquid, it's very challenging to design a product that is going to have uptake in the DeFi space, and that's primarily where I think you're seeing a bit of distribution on the Web3 side as opposed to kind of straightforward tokenized private funds. Now we'll get there, but that's kind of where I think we are now. So that's what I'm focused on.
Cool. Jeet, Amarjit Singh, I head up digital assets for EY in the UK. I have a slightly different tact here. I actually think, on one hand, actually, we are getting quite a bit of regulatory certainty now. And in fact, I think I even have some firms tell me that they are actually playing catch up to the regulator. My challenge is more on the legislation and on the accounting and on the tax. Because actually, even if let me rephrase that. When we get comfortable with regulation, if we still do not know what the legal certainty is on a token when we own it, and I think people might have seen, for example, the SEC announcement that came out earlier this week, but and we've been helpful in the UK with the recent digital assets law, but that question about what do you actually own, which country is it, what legal framework, what happens on insolvency, that I think needs clarifying and clarification. And then if you don't get the accounting and the tax right, well, nobody's going to invest in a fund because they don't know what it's going to do to their balance sheet. They don't know what's going to do to their tax exposure. They don't know what's going to happen in that way. So people would, firms would want to know what their ROI is, where it's going to sit. So I think we've actually got some more work to do now on making sure that we get the rest of this also bringing, to the level that it needs to be at.
Thank you, Jeet. Good afternoon all. I'm David Burrows, FCA Funds and Asset Management Policy, and I'm one of our leads on fund tokenization. So fund tokenization, we're looking at from the point of view, not just talking about our normal objectives, protecting investors, making sure markets operate fairly, but also looking at this from the perspective of growth and ensuring that the UK has got a competitive regime within the fund space. So we're wanting to make sure that the UK is seen as a destination to launch tokenized funds. Last year we did 2 bits of work that some in the room may be familiar with. First of all, we got out a consultation paper, Progressing Fund Tokenization, which is looking directly at how we can bridge the adoption gap. And we've also been working through Project Guardian, which is a joint initiative with Monetary Authority of Singapore, the Investment Association, the Investment Management Association of Singapore, again, looking at how to build a framework for tokenized funds. And we had a good paper out last year as well, looking again at how to bridge the adoption gap.
Thank you all. A lot of different topics here, a lot of different mentioning. Coming from the regulation side here, Liechtenstein is not only the tiniest country because it's the country with the first blockchain act in the world and token act. But adding to this one, the market is quite tiny now, but it has a lot of potential, of course. The blockchain infrastructure is, I think, safe. As the SEC, the guidance end of January mentioned, there's a new infrastructure, there's new plumbing, but the same rules. That's quite crucial. What do you think about this to increasing the market infrastructure, the market size? The money market funds were successful last year. They are successful. Maybe private equity will be the second one. Maybe. What do you think will drive the markets forward, David?
It's a great question. I think we've got to think about the utility. Why if you're a traditional wealth manager today, or you're allocating capital, what does the tokenized product give you that you don't get from the traditional product? And to some, look, I think, there have been many, and I've sat on many panels where we've all expounded about the potential benefits of tokenization, and in time they will come. But today they are available in limited form, and for the most part, and this is just, this is kind of our experience, at the most part, launching these products at the moment comes at a premium to traditional products. So that means that if you want to access these products, you're probably paying a premium for them. Now, I think, so that's sorry, I don't mean to sound overly negative, so it's Friday afternoon, so I'll try and cheer up a bit. But I think what we need to think about then is, what is the extra utility? And there are a lot of activities going on. There was in Europe last year, there was a really successful, the GDF sponsored a process around tokenized money market funds and the use of those as collateral in derivatives margining. And I think that was really successful, and it kind of really showcased, actually, admittedly, it was a simulation, but it was a very, very kind of a realistic one. And that's now being launched in the US as well. And so as we start to unlock those activities and those capabilities on these products, and I think over time, the underlying cost of the operations will necessarily fall. And I think we're seeing as many of the, if you want to call them the incumbents in the industry today, develop their support services and capabilities, those support and administration costs will fall. We get to a point where we have a product that is actually at least equal, if not better than the traditional one, and brings a whole load of new utility to it. And that, coupled with the regulatory clarity that I think we're seeing, is going to be is part of the process that will unlock this. And there's one final point. I think the other thing is, and I spend quite a lot of time in the sort of wealth space. I mean, the wealth managers have spent an awful long time making sure that they're connected to all of their product providers. They're all beautifully integrated into their platforms and so on. And I think today, for the most part, the digital asset ecosystem sits separate to that. And that, and what you don't want to do is make those, if you're making it hard work for people, it becomes a barrier to entry. So integrating digital assets into so we have a unified experience from client reporting, performance, and so on, equally will be kind of essential, I think, to getting mass adoption.
Yeah, that's really interesting. Building up on this point of the integration part of things, I really like. It's definitely true that these systems should be able to be in something that can be integrated into a current system that institutional players are using. Like, it shouldn't be an operational burden. It shouldn't be a tech debt in order to add a tokenized instrument into the portfolio. It should be something that actually adds more value. I would say it's also. We need to stop providing new rails. We need to convey that there's an operational efficiency that is around these kind of tokenized products that can be adapted by institutions. So better clarity around transparency, finality, ultimate finality that is immediately settled, and all these kind of risk management system that can provide a better operational efficiency to the final user should be more clear to the institutional part of things, to be able to scale adoption among more these kind of players.
I guess I would add, I think, just to put it really basically, when the big banks figure out a way to more profitably distribute, if we're talking sort of specifically here about funds, distribute products in the traditional channels, and I completely agree that there's basically currently a separation, I would say. It's at the point when they find a way to do that more profitably, and we're seeing that they're doing various things more profitably internally, but when they figure that out, that's when you're going to see, this question of when do we scale, and that's going to be when, and that's also going to connect. There's going to be an urgency then to connect the traditional distribution channels with, the digital asset native ones, whether that's private funds or whether it's more crypto related type things. I think that's the point when all of these things basically come together, and it certainly, the price of Bitcoin notwithstanding, it certainly feels like we're getting closer to that point than further away in the last 12 to 18 months. And is it in 3 years, or is it in 5 years, or is it in 10 years? It's hard to say, but feels to me like it will happen quicker than we expect, or we'll wake up one day and realize it's, we're all using the cloud or whatever it is, or they figured out EVs, So that's my view.
We did a survey, EY did a survey with Coinbase last year, and we're repeating it this year, and we've done it for a couple of years now. And actually the top two that came out were money market funds, followed by private credit funds. But there would be two points I'd make to the conversation that we've had. One is that I think the neobanks and their distribution channels are quite interesting. And in some of the conversations I've definitely had with neobanks, they tell me they can't put traditional funds on there because their customers don't understand T+2. And they said they'll actually have a consumer duty problem because people will click the button and not know where their money disappeared for 2 days. So they actually said to me, actually, if you can provide tokenized funds, and actually they can click the button and buy it and automatically settle it, they're very happy to start to put them on their apps. So that, to me, and again, if you think about that, that's not really cannibalizing existing channels. It's actually opening up a new channel and addressing a new market, which I think is really interesting. The second point I'd make is when I do talk to the wealth managers, to exactly the point David just made, they tell me they want product. They tell me they want private equity product, they want private credit products that they want to be able to sell to their professional clients that they deal with. And when I talk to the asset managers, they have product that they're willing to sell as well. So you got the push from one side, you got the pull from the other side. What's missing is the in-between. That connectivity between the asset managers and the wealth managers in this space. And don't get me wrong, tokenization helps, but I also think that there are some challenges. We need to figure out how we manage NAVs, how we manage, cutting NAVs on a fund that is monthly valued versus suddenly becomes daily traded, let alone weekend traded. How is that going to happen? We've got challenges on things like that we need to work through. I'm not smart enough to figure all those out. I'm hoping others are. But what is interesting for me is, again, that's another untapped market that is really quite interesting. And last but not least, just so that I don't, I think this helps both ends of the market, because on one end of the market, when you talk about private clients, professional clients, this is attractive. But if you also think about the other end of the market and the fact that in the UK, for example, we still have a savings culture, which we're trying to move to an investing culture. If you can actually tokenize funds to allow funds to be drip fed at a far smaller amount than currently possible, the inclusion, the financial inclusion that you drive there starts to also, again, change the game for what we're trying to do. Because suddenly it might become possible to have a product that allows for £20 to be drip fed or something, which currently is just not really cost effective. So I think these are quite attractive propositions. I'm not smart enough to figure out how we make them happen.
Thank you. I'm going to say I agree with all of the previous speakers who've spoken, but I'm going to start by picking up from where Patrick was speaking around the pace of change. And I think we're probably at the moment when we might start seeing the tipping point and things kind of like run into this bigger tokenized ecosystem. And that ecosystem is ultimately essential for this to progress. Because if we just start with where we are at the moment and people looking at it and going, well, why would I pick this tokenized fund over a non-tokenized fund? And there has to be some incentive for them to do that. Now, that incentive may be that there's a specific utility. They're a very strong crypto-native, crypto-friendly investor, and therefore going through neo-broker or a trading app is kind of where they're comfortable with. And we do understand that some younger, but not all young, tech-savvy kind of like in general investors may be in that category. But there's also other specific utilities. So collateral mobility is kind of like one of the key drivers for people to launch tokenized funds at the moment. Take a money market fund, you can use it in kind of multiple other ways if it's tokenized. But if we're looking at a kind of fund that you kind of like moving up the yield, moving up the risk curve and moving into something that's corporate bonds or equities, people then look at it and say, well, hang on a second, what's the value in that? Because some of the features in that fund seem comparable to where I was before. And that's where the ecosystem part comes in, because ideally you want a scenario where you've got tokenized funds that are investing into tokenized underlying assets. And it's only if you get into that stage that you can get rid of some of the potential imperfections out at the moment. And that would largely be that the fund settlement cycle can't be ahead of that of the underlying assets if you've got any sort of expectation of providing that liquidity, because ultimately someone's going to have to step in and bridge that gap between the settlement periods. It's very similar to what we see in a traditional fund setting for T+1 and so forth. If they're running a kind of fund, the other kind of approach to that is rely on secondary trading, then you also need that full ecosystem for there to be sufficient liquidity in that secondary trading. And that's what we're seeing a lot of the time where we're looking at products that are more private equity, private debt capital based, where there's a challenge there as well. And I think once that ecosystem's there, I think that snowball will kind of genuinely pick up, and people will then look at it and go, well, tokenized is now the default. And then we get to a point where firms aren't having to pay to maintain tokenized infrastructure and conventional infrastructure. And then it gets a lot cheaper on the tokenized side because there isn't people paying for two separate platforms.
Yeah, great. Yeah. On the regulatory side, there were huge steps last year. Of course, MiCA with more than 60 CASPs now in Europe with the advantage for passporting, Genius Act in Asia, Hong Kong, and on and on and on. Maybe a Clarity Act in this year as well as a stateside regulation. What do you think is still missing on the fund side, on the regulatory side? Is something missing, or is the regulatory page mainly complete? What's your view, David?
I think there's still an awful lot of fragmentation in the world, in the tokenized world, if you will, at the moment. We've been talking for a long time about the ability to, you tokenize on one fund, and then it's almost kind of captive on that particular chain and can't be moved to another one. So the whole kind of interoperability and fungibility is kind of really quite important, I think, for mass adoption. Excuse me. And I mean that's starting to come, but and I think there's also quite a lot of there's a lot of distraction as well. I mean, I think we've seen a lot of activity in the sort of derivative securities market in the last year, and I mean we've got in the US we have a very successful ETF, the Triple Q Fund, which tracks the Nasdaq index, and I think there's something like 37 variants of that people have done. They just basically take the index and off they go and create a token, and those different variants aren't fungible or aren't interchangeable. They're completely different. They've got different risk profiles attached to them. So it's quite a confusing landscape. So I think standardization, some standards around how we structure these things, these kind of things, and they're coming. And I don't, but it's going to take a little while to kind of get some clarity there. And we've seen a lot of activity with the kind of traditional exchanges now starting to think about the fundamental underlying fundamental market infrastructure that needs to be there. And I think there were a lot of big strides taken last year, and I expect that to continue through this one.
Thank you. Maybe Matteo to add, which blockchain will win in the end?
Oh boy, I wouldn't say it wouldn't be about the actual blockchain. It's about the efficiency of the blockchain and the programmability and the capability of that blockchain to be as much programmable in order to provide operational improvements. From a fund perspective, or I would say from like projects and companies that are providing tokenization, I often see that they start from the asset and then they stop at the token, which is completely wrong in terms of like institutional adoption. There's a number of different things and aspects that you need to curate before going into the token, into the wrapper, and deciding what is the wrapper of that specific traditional assets that you're trying to tokenize. You need to start from distribution. You need to be sure that you're servicing the right kind of customers and that there is demand for the kind of product that you're tokenizing. You need to make sure that the information and the data flow that you're creating around the tokenized product can adapt to the system of the institutional fund that is adopting it from a buy side or a sell side. And I would say, of course, from a standardization perspective as well, we cannot like really build on top of bespoke requirements, bespoke limitation, bespoke system around tokenization. Otherwise, this pretty much stalls the scale of the adoption, the rate of the adoption for tokenized products. So I would say standardization is a really important aspect of for institutional adoption, because it brings scalability at a speed where we won't even realize that these kind of tokenized products are already adopted by institutions.
Maybe partly coming from the fund industry, there's a lot of legacy system, like in the banking side of course, legacy systems, which are very stable, which are functioning, which are conservative. How to bring this off-chain world on-chain?
With great difficulty. Yeah, I mean, there's an awful lot of fragmentation, and you know, in particular, if you are launching a fund, you know, we don't all have the benefit of having Invesco as our name, unfortunately. You know, there's an awful lot of planning and thinking to do around, you know, what is the jurisdiction of the clients you're targeting, and then figuring out the fragmentation there. But I think where it becomes really, really challenging is there is this issue of there's not an awful lot of demand for tokenized products amongst traditional investors. And so if you have a tokenized fund, you're really targeting a pool of capital that is digital asset based. And then you have to structure a product and understand the thing, what Matteo was saying, understand what it is that they are looking for. And it's a very different mindset to traditional investors in a lot of ways. And that's a whole, you know, that's a whole education that's required really to figure that out. So you're trying to take what you know from the TradFi world and figure out what is important to the DeFi world or the digital asset investor world, who the right parties are, how that needs to be curated, how that needs to have a lot of things that you wouldn't normally need, which is like in particular what Pareto does, for example, connecting into these other elements of the ecosystem that create utility. And it's very, very important to have that for broad-based distribution as of today, right? There may be a different future in which, you know, there are tokenized funds selling to traditional investors and everybody just kind of, you know, looks on their wallet and sees all of their assets there. But as of today, there's kind of a lot more that goes with it. Some of it's practical, some of it's regulatory, and so there's a lot to stitch together, and you really have to get very, very deep into the weeds and understand specifically who it is you're targeting, and then kind of backfill every element of that to make sure that there's a product that can actually reach them.
Yeah. Thank you. Amarjit, coming from one of the big fours, you are very crucial in its process as to audit customer and to authority. They require audits, be it financial, be it tax, be it compliance. How do you manage this on-chain?
I think my word for 2026 is ecosystem. To what Patrick's just said, right? I think, you know, 2025 to me was regulation. 2026 for me is ecosystems. We need that ecosystem around now to be able to do what we need to do, be it the distribution, be it the manufacturing, be it the attestations, be it the tax authorities, be it the legals, be it the auditors and accountants, because we've got to bring trust in this space as well, right? We've got to bring trust in this space because we've definitely already seen it. A couple of years ago, working with some of the more crypto custodians, for example, you know, when you went to see them and talked about things like a controls report, they looked at you as if you were from the moon. But then they quickly realized that if they were going to custody any institutional money, they needed to basically do what was expected of an institutional custodian. And all of a sudden, you started to see them producing these reports and starting to get up to speed and starting to do what, you know, people expect to see. Third-party risk assessments, third-party risk monitoring. You know, that's the latest thing that now a lot of the firms in the space are waking up and going, OMG, I need to know who's in my ecosystem again. I need to know who I'm doing all this for. I need to know who my third parties are, which to me is even more critical because this is a 24/7, 365 world, right? There's no downtime. There's no time to, fix things at the weekend when something's fallen over. Everything seems to also happen in the crypto space on a Friday night, on a Saturday morning, if nobody's noticed that already, right? So, things like that are so critical, Heinz, in terms of what we need to start to do. So for me, I don't think there's just one party, but I think very much what I hope we start to now build is that ecosystem that we need to get to where we need to get to, sir.
Thank you. That's a great adding. To David, maybe the ecosystem as well. What's your view in your role on the ecosystem and on the requirements and about your requirements?
Absolutely, yeah. So take that. I'll start first of all with talking about standards, because we think that standards are super important. And we're not here to pick winners as a regulator, clearly being appropriate, but we do want to make sure that there is confidence in the market. And good standards are obviously a way of delivering that. Equally, there's a question of confidence. And that confidence is critical in bringing people to say, we want to launch these products, and then we can sell that product, and if the product's good, it will sell. But on that, the way we've always approached this is from a perspective of technology neutrality, right? So we focus on outcomes. The consultation that we did last year and working through kind of a crazy amount of responses to it, absolutely brilliant. And many of firms in this room may have responded to that, the sort of level of detail and thought. Thank you all very much. But we're looking at it from an outcomes-based perspective, right? So our existing rules don't actually dictate how, say, a transfer agent system has to operate. It talks about that the outcomes that transfer agent system must deliver, right? So you must be able to produce reporting to the depository or any fiduciary entities if you're in a different entity, or a board of trustees or whoever else you're kind of providing that reporting to. It needs to make sure that some common problems can be resolved. So if actions of a court can be taken forward, if somebody kind of like passes away or if somebody gets divorced, scenarios like that can be dealt with, right? There's some sense of ability to apply that. And equally, if somebody forgets the key, right? Now, we see scenarios like this, the chap working through a rubbish tip to try and find a private key. It's obviously not a good outcome, but if that happens with somebody's savings that they were going to use for their children's education, or if that happens with somebody's pension, you're in a situation where people just won't buy products like that. It's not actually something that regulator should need to intervene on, because the market will find a level and things like that. We'll jump in first, don't we? But it's kind of getting to that point and making sure the products that are coming forward are good quality products to meet the needs kind of like a defined target audience, and then I think we'll kind of have the win, and that ecosystem will start building up.
Yeah, thank you. Being the last panel, I think we can do a little bit more the big picture. When blockchain started as an infrastructure years ago, it was the opinion, banks, we do not need banks anymore. That was an opinion. It seems that banks are the winners of the blockchain infrastructure. And a question to you all, what are your views and your big picture in this industry, as that's the common sense, I think, that will increase fast, that you are on the right picture of the page? What's your view of the market? How fast it will go? How secure it will be from the authority side? Not a lot of misbehavior, a lot of more compliance maybe. And the big picture is it will be a huge industry in some years. We talked about one of the biggest US banks some weeks ago, and the corresponding side, and they focused on, of course, AI, then blockchain and stablecoin with blockchain as the big impacts in the future in the financial industry. Is this your picture as well? What's your view on this side?
I think there's a firm conviction within our firm that this digital ledger technology, blockchain, will be transformational in what we do. what will need to happen though is that we've kind of touched on all these and it's still very early. I think probably most of the people in this room have been around it for a while, so feel like it's taking forever. But the reality is it's very early in its adoption curve, and it's going through some of the same teething issues and introductory issues and acceptance issues that many other technologies have gone through. And I think if you compare the rise of Web3, if you want to call it that, versus Web2, the adoption of wallets versus people online, I think is a much steeper curve. So already I think we can see that adoption happening. I guess there's a few things that are going to happen. We're in the middle of this kind of generational wealth transfer. Yeah, so I think we alluded to this. There's a generation coming through where everything is digital first, and they're going to that's absolutely going to be the experience they expect and need, and that will drive how we need to deliver products and services to some degree, and I think. In terms of the actual speed at which it happens, we will see over time. There was some ridiculous stat I saw yesterday about the number of coins that one of the coin people have actually, or tokens that they're out there. It's in the millions. But that is all. We're going to get that kind of consolidation. I don't think there'll ever be a single, there's not going to be one blockchain to rule them all, I don't think, but we're already seeing to some degree a certain amount of focus, and I'm sure there will be different protocols for different use cases that will make sense. Essential that they can talk to each other, I think, when we're starting to see those things happening. So, and we'll get to that point whereby, it won't happen, and then it has happened. And I think if you're an organisation like ours, we're 8,000 people, and a lot of those people really have probably very little exposure or understanding of this whole digital asset thing. So, and it takes you've got to build that institutional mindset around this, and that takes time. And we've been probably doing it for 5 years now, and I think we've got a long way to go. But somebody described it as kind of like, the adoption of this thing is like the tectonic plates when two continents start separating. And I think as it starts to accelerate, you want to make sure you're on the right side of that continental divide. So, which is why I think the work we do today, and Patrick was mentioning, we talked about this Web3 distribution channel. It's really great in terms of it's enabling us to build muscle memory to some degree and that will then serve us as we see a much wider adoption as we move forwards.
Yeah, I agree with that in the sense that I see we are at the point of a convergence between the two kind of like the traditional world and the Web3 world. So there's definitely a convergence, and we are not at the pilot phase anymore. That's for sure. Of course, there's still some gaps that needs to be filled in terms of regulatory clarity. What is a token? What's the tokenized product representing to the final user? So there's still some gaps, but I feel that like all the different parties that are involved into the structure and into the tokenization process are actually willing to be proactive in order to improve and make sure that we have a future where it's a digital native finance completely on all the sides. And so I'm pretty positive on that part of thing. I think there's still work to do. There's still like conversation that needs to be done. And the education on both sides to be done, both to adapt the DeFi system to the TradFi system and the TradFi system to DeFi system. But I actually tend to agree to the generational part of thing, because there's this kind of generational transition that is happening right now, and all the application, or even financial and non-financial, would be digital first. So having a financial system that is completely built on digital rails, on on-chain rails, would just bring more efficiency to the entire system.
Yeah, I guess I would just add from this notion of a continental divide, which I think is very accurate. There really is going to be an advantage for the people who are sort of, whenever this fully kind of materializes, and I think it will be sooner, but those larger managers who have figured it out and spent the time and been in the trenches for a while are going to have a huge advantage. But down sort of at my level, my team of 8 versus 8,000, it's a really exciting time, because that that divide is actually creating a lot of opportunities for independent managers like ourselves to bring institutional products to people that haven't had them. And some of that is on the traditional side, in the wealth channel, for example, and some of that is on the digital assets side. And so, we are able to bring, for example, exposure into the tier one reinsurance markets. That's just not existed. And there's really no one else, doing what we're doing in that space. And that kind of atmosphere, I think, creates a lot of opportunity, and you're going to see different and new platforms who emerge. And I mean, they already are emerging and are becoming very large, but I think you're going to see a lot of new players then who become, very large players, and in 30 years we'll look back and say, Pareto, those old dogs, which is a fun time to be alive.
Of course.
What excites me about all of this world, to the point that both of you have just made, I look at the picture that was painted by MAS in their paper on tokenization, where, it's real enough that actually I can see that happening. The ability of an asset manager to say to a custodian, tokenize everything that you own for me, and then allow me to take those tokens and put them together in any way, shape, or form I wish to create the outcome that I need to for my particular client. That, to me, is immensely powerful. I think that is a superb idea by MAS and the group of asset managers that came up with that, and I see that the FCA were part of that and have taken that on as well. The power that gives to me is incredible. The ability that will create, the opportunity that will create for institutional managers or managers like yourselves, etc., and others, is, to me, immense in terms of what that may allow people in the future to actually be able to do with this technology. For me, I think, yes, we are early days. Definitely, we are early days. I always say, we're in the 1984 days of the IBM PC, right? That's, where we are now, I still think. We've got a long way to go, but I'm really, really excited by what I can see the potential is that this allows firms to actually start to innovate and do that at a very different operational level, i.e. with far lower operational framework, that framework's the wrong word to use, burden may be the better word to use, than current traditional business models require.
I would agree. Again, this is doing well today, aren't we? Yeah. So start point would be as well that generation kind of like wealth transfer is real. It's kind of like visible in kind of like statistics. It's visible in marketing. And where we talk about what's going to happen this year, I see it as a sense of delivery, right? We're going to actually start seeing things come out to market. So I'm going to plug the own consultation paper again for a second. Apologies, but in that, we tried to tackle 3 issues that had come up in the asset management task force and with some of the trade bodies kind of in the UK. And they were, first of all, use of public networks, right? So yes, we confirmed you can use the public network for regulated funds, provided you can meet the authorization resiliency rules. Then it was on-chain cash, right? And where does that sit? How can we have something that allows you to actually do the atomic settlement, which is a big win on this? And we've opened the door to that. We've set out to industry, here's potential text, a rule waiver that could be used to allow you to use stable coins to come in and out of an authorized fund. Then we look at tokenized assets. And again, tokenized assets, technology neutral. If it was eligible for that category of fund, it will be in future. Moving on then, though, we start to see, well, yeah, that will go live, but then the question comes, I think, in terms of how fast will things move? And we've got tokenization funds, tokenization of assets, tokenization of cash flows, but we are looking at a potential future, apologies for the title being bringing institutional funds on chain, where funds may not be needed because people can simply hold the underlying assets. The fund is an aggregator vehicle that brings together pots of money to a size and scale at which it can be efficiently investment managed, right? But in a tokenization space, that's not necessarily the case. It's sort of G said a second ago, the people that are investing £20 a month now going via a fund to get access to the mainstream index. But in a tokenization setting, they may just be able to acquire a fractionalized interest in all of the shares that make up that index, minus ones that don't fit their own personal ESG kind of like view, or so I think very interesting future, and hopefully some delivery this year.
Thank you. Running out of time. Well, yeah, very fast. One short remark from your last round. What will the tokenized world will be in 3 years?
In 3 years, I'm going to have to tell you what I'd like it to be rather than what I think it would be, because it's kind of anybody's guess, isn't it?
Of course.
And if I knew, I probably wouldn't be sat here. But I would really hope that in 3 years' time, we don't talk about tokenized funds, because the word tokenization is, we don't talk about the fact that a fund sits on an Oracle database today. So why would we talk about it? So it should just have disappeared from parlance. We will have more efficient ways of delivering products that clients want. I'm super excited about the whole kind of hyper customization piece that you've just alluded to, David, in terms of the ability for us to tokenize all of our investment capabilities, and basically they can be put together, God forbid, with an AI agent or something like that. But that whole world where people can get a product that is genuinely tailored and customized towards their needs and wants, I think that will be super exciting. And that we don't have to reinvent the same product in 15 different parts of the world. We can build it once and configure it and deliver it to other clients. Now, that's probably a tall order for 3 years' time, but I'll don't put me on the record, but that's what I'd like to see.
So yeah, I would say, well, first of all, given the fact that all the underlying assets actually would be tokenized, I think we should be talking more about building institutional funds on chains, not bringing institutional funds on chain. In the next 3 years, as a possible developments in terms of actual assets that would be brought on chain, I would say there are three main features, three main characteristics of these assets to have. They should have a clear valuation methodology, a clear redemption, and also market demand, of course. Right off the bat, I would say those would look like cash-like instruments, repo-style instruments, or secured lending, or even some form of institutional private credit, where the reporting and the transparency side is already clear for the issuer, and it's able to integrate it within the system and provide it to the final user. So it's really clear. It's really important to start with simple and clear assets that can get the institutional users and in general all the users comfortable with these kind of tokenized products, and then proceed from there into more structured kind of products and complex kind of fund of structure of funds. So I would say that would be the way that I see the evolution in the next 3 years.
Well, I have a slightly left of center prediction, because I think it's going to be hard to pick panels in 3 years if we abstract away these types of topics. So maybe these kind of events become much more crypto focused, and we can break out the unicorn onesies and so on. We'll see.
Cool. I think what I would hope is that continuing the sort of evolution, that actually from an accounting and a tax perspective as well, that all of this is agnostic to accounting and tax. So basically the outcomes that the new either crypto or institutional funds that are built on chain, etc., are all treated as an agnostic fashion. As David said, we don't distinguish between them. They look and feel and act like how we would expect them to act. That's where I hope we are in 3 years' time.
Thank you. And I would say that for this kind of coming year and coming kind of period, I think what we're looking forward to again is further conversations with firms, further conversations with trade bodies. The door is very much open if people want to come in and talk to us, both through the normal authorization channels that we have, and indeed via the various sandbox regimes that we have. The onus of some firms to build good products that meet a defined need for a consumer or an institution. Absolutely looking forward to those conversations in the next few years.
Yeah. So that was the end. Thank you for a really, really great panel and your contribution. And thank you all for listening. Thank you very much. Nice weekend.